Good morning, everyone. Welcome to our Capstone Coffee Conversation. Today is March 12th, 2024. My name is Brian Felshaw. We're here in sunny Silverdale, Washington. Finally, it's been rainy for a long time. And I'm joined here by Ryan Skogstad. How you doing, Ryan?
Good. Doing
Good.
well, thanks.
Today, we're going to be talking about some things, some common questions we've been getting from clients, specifically about investment yield, and that includes dividend yield and bond interest. And today's also going to be kind of a little bit more practical and kind of some real world examples of how to look for that on the website and how that looks maybe on an investment on paper, and focusing on how that can help you as clients be able to identify and understand what's going on with your accounts. So I want to start with a personal story. This is about a week old. My family's growing. We pulled some money out of our investment account to buy a new minivan so we can take the kids around town. And I logged onto my accounts on the Schwab website and just to see how my accounts were looking after that withdrawal. And I was a little surprised to see that it said right there on the homepage, year to date, YTD, that I was down 10%. I thought that's odd. So I went over to the Capstone portal, which a lot of you are probably familiar with, and I looked at where my account was year to date from there. And it showed that I was up 6.5%. And I thought, okay, that makes more sense. I've gotten some dividends and interest. I know it's only been 2 months or so in the year, but I should be up a little bit. And I thought, why is that showing such a big difference? And one thing I noticed as I dug around on the Schwab website was that Schwab was showing my withdrawal as if it was a loss on the account. So, and even though it wasn't, even though my performance between market growth and the dividends and interest that had come in during first quarter showed that I was positive. So we thought that would be kind of an interesting place to start because many clients for the year maybe have pulled some money out or put some money in, and that return might look a little bit different on the Schwab website for you. It might appear better if you're putting more money in, or if you're making some major withdrawals, it could show that you're down when your performance is actually pretty good, mostly at this point because of dividends and interest so far during the year. That's that return that I saw on the Capstone portal is called the geometric or time weighted return. It shows the timing of the ins and outs of the growth and not necessarily just a percentage change of how much money is in the account that Schwab was showing. So we thought that'd be an interesting place to start because also, in addition to that, some of the funds we use show a return on the statement or on your account when you log in on the Capstone portal or the Schwab portal of how far they're up or down, but may not show the bond or excuse me, the bond interest or the dividend yield and how that works.
Yeah, I think it's important to know if you're looking at your time-weighted rate of return, as you mentioned, or just account value change. Right. And so make sure that you kind of check in on that. We'll get to the end of the year many times, and I'll have a client ask questions like, well, how come this or that? And I'll say, well, remember you took out X amount of thousand back in February. And they'll be like, oh, wait a minute. I guess you're right. I did do that. So, sometimes at the end of the year, January, February, March seems like a long time ago, and we forget some of those things. So important to kind of clarify, is this just account value change or is that my investment return? So that's kind of big picture. And then I was going to drill down now to the individual positions within an account and how they grow. They're created differently. Stocks might be created a little bit differently than bonds, and then certain types of stocks are created differently than each other. And so they can each have a different kind of goal in how to assist an investor with growing their wealth. And so kind of putting those together is kind of what our goal is to do, is to try and with as least amount of risk possible, combine certain types of high yielding stocks with maybe some other types of positions which are not focused on yield to create a portfolio. So let's just dive in a little bit into yield and dividends, and then also unrealized or realized gains. So a yield-based investment is going to be things such as today, cash or bonds or higher dividend paying stocks. But think of yield as like incoming interest. Unless something drastically changes, that is what the bond or the stock has committed to pay on an annual basis. All right. So if I sign up for a bond that's paying 5%, that is my yield for the year. And I'll get 5% per year until that bond comes to its maturity. If interest rates never changed, then my return would be 5% every year. Okay, so the yield is your implied interest that you're going to earn in cash flow, kind of money coming into your account on an annual basis. And a stock will also pay dividends sometimes, or certain stocks will. And a dividend yield is same type of thing like a bond. A company will announce a dividend and they'll say, we're going to pay 3% dividend going forward, right? Now they can change that. If the company, really struggles and cash flow is low, they could lower that dividend. And if things are doing very well and they have great cash flow, they could raise that dividend, right? But most times they'll announce a dividend and they'll try and make sure that they stay true to that dividend for a certain amount of time. And so stocks can also pay a dividend, and we call that the dividend yield. Okay, so bonds have interest-based yields and stocks have a dividend yield. Contrast that with something like a stock that doesn't pay a dividend. Its goal isn't current income. Its goal is for longer term price appreciation. Okay? So if you buy a stock that doesn't pay a dividend, you're now only hoping that the price of that stock goes up over time, because there is no benefit of holding that stock and earning a dividend or cash flow back into your account. The only benefit is price appreciation over time. Okay? The unrealized gain that you might see from a position or from a stock is not an annualized or a per year number. The unrealized gain is simply the difference from when I bought the stock to where it's at today. So on a very short-term basis, we might have a small unrealized gain or a small unrealized loss. And as time goes on, if you held the position for many years, you could have a very large unrealized gain. You could also have a large or small unrealized loss, but it's not calculated as an annual number or here's what you're getting per year. So the difficulty for a lot of times for clients is we'll see, well, this stock has a small unrealized gain, or this one has a large one, or this one hasn't done much, or this bond has no unrealized gain, this bond has no gain. The difficulty is you have to look at how many years you've held the position, what is that unrealized gain or loss, but then you also have to look at the yield and how long you held that position and what was that yield every year, and add that to your unrealized gain or loss. And that's how you can kind of formulate a return that you've received from a particular investment. Obviously, we have the software that can tell you exactly what that investment has done since you've been maybe invested in that position. But to try and just calculate it from yield and unrealized gain can get challenging, but you have to use both of those in concert to understand what that position has done for you. I wanted to show an example of a fund that we use and kind of highlights the difference between a price appreciation return and also the price plus yield of a investment return. So we're looking at a short-term bond fund that Moesha has pulled up. It's the PIMCO Low Duration Bond Fund. Many of us hold that in our accounts. It's fairly kind of a safer fund. Today, bonds are paying 4.5%, 5% return with much less risk than a stock position. So, we we're kind of a fondness today for some higher yielding bonds. Well, for this fund, you can see the lower number. What color is that, Moesha? Is that the purple? The purple line shows the price growth of the low duration bond fund. And you can see if you've held that fund for 1 year, this is a 1-year number, you've gained about 0.5% in price appreciation in this fund, right? So a little bit of a gain over the last year. But then if you look at the top line, which is orange, the top line shows your yield plus price appreciation return, which today is about 5.5 over the last 1 year. right? So the price appreciation of the low duration bond fund, pretty negligible, but a 5.5-ish% return on a total return for that bond fund over the last year is kind of what we're shooting for. And so you can see 90% of that return has come from the yield, with just a little fraction of return on that fund coming from the price appreciation. So unrealized gain small, yield large in relation to that investment. So it's really important, I think, to understand not all investments are created equally. You know, some are shooting for more current income, and some might be shooting for longer term price appreciation. Putting those together, but not comparing apples to apples, is what creates a portfolio.
Yeah, anecdotally as well, I've had conversations as we do reviews with clients about looking at their statement or looking at their funds, and they see one fund that, you know, this one's up 100% or something like that, and it's performed, its unrealized gain is very, very large, and they may have held that position for 7 years or so. And maybe we just recently bought a bond fund in the last year or two, and its unrealized gain may even be 1% down or something like that. And we look at those two and think, well, this one's doing much better than that one. We should put more money in that one. Well, they have different objectives, and also the time that we've held that has been much different. So comparing, like Ryan said, apples to apples of the investments, what's the purpose of one? Is there a yield on it that we're actually looking at, not just the unrealized gain or loss? And also, how long have we held that for? That's another key piece.
Yeah. Go ahead.
Yeah. So just to kind of bring this all together with why is this so important? We have some statistics just to share with you, courtesy of of First Trust, who we had on a couple of weeks ago. For the calendar years 2019 through 2021, the price appreciation of the S&P 500 was 90%. The total return was 100%. That 10% difference came from dividends. That is abnormally low. Looking back from today through the 1920s, the stock market, 39% of its return came from dividends being reinvested, a much larger number than that 10% of the last couple of years. What does that mean? Why is that significant? Well, it suggests, as we know, things tend to revert to the mean. And so as we look at where can we allocate money to get the best bang for our buck, to be able to help our clients be successful, we're looking at that trend that dividend yield has not been a significant portion of the return the last couple of years, and that it very well could be the next couple of years, because we know that things tend to revert to the mean and maybe get closer to that 39% more significant figure. When we look back at the pandemic and you know, the last couple of years, tech companies have dominated the growth of the market, and many of them do not pay dividends, and they've become a big piece of a lot of investors' return and their portfolios, whereas the dividend yielding companies have not. So we look at that and we think there may be an opportunity there to help take advantage of the fact that that could revert to the mean. So something to keep in mind. This is very important. So, do we have any softball questions, Moisha?
Why do some companies pay dividends and others don't?
You want to take that one?
Yeah, sure.
Okay.
I think the difference many times comes to the maturation of the company. So if you think of a newer company or a really growth-minded company, I call those small companies, or even, you know, a company such as Tesla, which isn't so small anymore. The cash flow that Tesla or a kind of a smaller cap company receives is utilized into building more factories, adding employees, growing out their tech, kind of reinvesting that cash flow into substantial growth, into future returns for that company. So kind of smaller base or really growth-minded companies typically are the ones that won't pay a dividend or pay a smaller dividend, because they're reinvesting that cash flow. On the flip side, a company that is much more mature, Think of something like a Pepsi Cola, General Mills. Pepsi's not out creating numerous new factories as we speak because of the surprise in Pepsi that is being consumed around the world, right? It's a pretty mature business. It can set its watch to how many cans of pop will be sold a year. And so it takes their cash flow, and instead of kind of plowing it into building more factories, it takes their cash flow and returns a dividend to shareholders. I think Pepsi's just north of 3% today for a dividend yield. That's a pretty healthy dividend yield for a stock. So it's returning cash flow to shareholders. And so that attracts new investors because that's a healthy dividend. So kind of think growth-minded, innovative, smaller companies that need that cash flow for growth, probably a little bit less of a dividend. You're basically betting on future growth prospects of that company. And more mature companies, a little more stable and not as growth-minded, will usually typically pay a higher dividend.
I'll even add, a lot of the funds that we use will even use dividend growth, a company that's been growing their dividend, as kind of a quality metric to show that, hey, if this company's been doing this for the last 10 years, they are probably pretty healthy.
Yeah. And Brian mentioned, over the last 100 years-ish, 39% of the total return from the stock market attributable to dividends and dividend reinvestment. That is meaningful.
Yeah.
Right. So it shows good stewardship to shareholders when the company's paying a good dividend. Any other questions, Moesha? No? Okay. Good. Well, thank you for being here at Capstone Coffee Conversation. As always, feel free to shoot us emails or phone calls if you have questions about this or anything else in your account and want to understand it better. We're always here, happy to help, and we look forward to seeing you next month.